Hello and welcome back to Smart Money Results. We have with us two very special guests today. They're Jake Stenziano and Gino Barbaro. Mr. Stenziano is a #1 best-selling author on Amazon.com and is the founder of Rand Property Management. Mr. Barbaro has 25 years of experience as a restaurant owner and is a certified professional coach. Together, they have created a multi-million-dollar real estate empire, investing in over 1,400 multi-family units. They also launched jakeandgino.com, a resource designed to help everyday folks achieve life-changing financial independence. Gentlemen, thank you so much for joining us at Smart Money Results.
Thank you for having us.
Hey, thank you.
Yep. So my first question revolves around your specialty toward multifamily units. When most people think about real estate investment, they're usually thinking about single family residences. What are some of the advantages of going the multifamily route?
Jake, I can take that first. I mean, when Jake and I first started out, I was working at the restaurant, and that's what I thought. I said, let me get into multifamily. I don't want to flip houses. I want to create a business. So when you're looking at multifamily real estate, I think the biggest difference with multifamily from single family is really the scalability. Is really being able to buy multiple units, 10, 15, 20, 100, instead of buying one closing at a time, one single family home. The ability for you to velocitize your money, the ability to create a business, the ability to have those economies of scale all come with multifamily. And that's why for us, it was just a terrific model. And from there, we've been able to branch off and do something called multifaceted multifamily, where we're able to create other streams of revenue from our multifamily investments. Some examples are we've created an education company called Jake and Gino. We've created a syndication company called Rand Partners, where we're doing deals through syndication. We've created a capital company where we're doing mortgages for our students. And we've got a property management company. So from that one 25-unit property that we bought 6 years ago, we've scaled up to 1,000 internal units ourselves, just me, Jake, and my partner, Mike. And we've added an additional 500 units of syndication on top of that. So as you see, as you start growing, you're able to add on other multiple layers. And in multifamily, you have the ability to have other layers of income inside the asset itself, whether it's laundry income, whether it's utility income, whether it's billing back tenants, application fees, late fees, pet fees, all these fees you can add on multifamily, and you start growing out the business that way.
Yeah, Gino, I'd like to touch on that a little bit too, because I think it goes back to limiting beliefs and thinking too small. A lot of people you just touched on, they want to buy a house and then they want to rent that out. And I know the pain that all the people out there that own houses, because the minute they turn that thing, someone destroys it, all that profit for the last year was just eroded. And I know people out there listening are feeling that pain. What we realize is that with the multifamily space, we're creating a true business. It's not that we're going to have this multifamily, or like this one single family home over here. We're going to have a little Bitcoin over here, maybe a little bit of stocks, and then we're going to continue working our job. We actually created something that created generational wealth for my family and for Gino's family. So it's actually taking control and treating it as a business with these multifamily apartments. Gino touched on the multifaceted part. We have 4 businesses that are all centered around multifamily, and it's basically just pushed everything else out of the way because it became a waste of time. You have so many doors feeding each other that if someone moves out, that's fine because we have another person moving in. We have other, units that are covering that, and it just becomes more scalable. The way you look at it is you have a bunch of boxes, essentially. You take a single-family house, they're all different. It's challenging for maintenance men to get there. They're all over town. It's challenging because they're all built differently, and it's just confusing. We have centralized locations where they're all very similar, and it's scalable for the maintenance men as well because they can go in, they understand how to fix one up because the minute they do one, the next one coming behind it is going to be the same when it comes to the turn. Turn costs are much less as well. You're going in, you maybe 800 square feet, 1,000 square feet. When you go in and turn it, it all becomes scalable, and you can create a business around it.
I think that sounds completely makes sense about the synergistic opportunities about creating businesses beyond just the target of the investing in multifamily units, but. When most people think about, for example, owning an apartment building, they typically have the idea that they need to be multi-millionaires to begin with before taking this approach. What would you say to people who are thinking this way?
Gino, you want to tell them how we started off with the first unit? I think that'd be fair.
Yeah, well, I mean, my very first deal was back in 2002 with my brother. It was a fourplex. It was residential financing. Anything 4 units or below, you can still get residential financing. Qualified for the loan, basically on the income approach. Bought my first deal. I had that deal for a long time before Jake and I decided to, you know what, let's get into multifamily. So what Jake and I did is we partnered up. Multifamily business and real estate, I mean, as anyone on this call should know, is all about networking. It's all about partnering. It's all about building out systems and building out teams. And Jake and I partnered up on our first deal with my brother, the three of us. We had a 25-unit deal. It was a $600,000 deal. To us at the time, that was a lot of money. So how do you qualify? You've got partners. And we actually ended up getting what we call in the business seller financing. We had the seller actually hold a note. We created a note, and we were able to come up with less money on the down payment, and that's how we got into our first deal. On our second deal, we brought in another partner which his name is Mike, and now he's been partners with us since our second deal, and we were able to scale up. So if you don't have the money, you can go out there and find the money. You can partner with other people. And if you can't do that, then what you do is you learn a strategy called syndication, where you're starting to raise funds from investors. It's a little more complicated. It's with a lawyer, but I mean, you can go out and you can learn about it online, listen to podcasts, and then when you're ready to go, find somebody out there who's teaching it, learn their model, and you follow that process. And you're able to syndicate, which is like you're creating a security for a property. You have to have private placement memorandums. You've got to get subscription agreements and operating agreements. It's not that difficult. We're on our third one. We started doing it in November of last year. You're able to go out and get what we call limited partners or equity partners, where they put money into the deal, you raise money for your deal, and you get into the deal. You start taking deals down that way. You want to expand, Jake?
No, I do, because I didn't come from any money within my family. I wasn't ever handed anything down. I'm 37 years old now, and we control basically a real estate portfolio of over $100 million. So I didn't, and at the time I was making, decent wage, maybe like $100,000 as a drug rep. So I wasn't out there killing it. I just saw something online that said that's like the minimum living wage if you live in New York City. So there's people out there that, maybe to some still sounds like a lot, but it just means you might need a few more partners. So I don't think that's true that you need to start out with a ton of money. You need to be scrappy. You need to be resourceful. And even some of the guys on our team that we've brought on since then, we have guys in their mid-20s that have over 100 doors under their belt as they've grown with us. And even the Jake and Gino community in the last few years has done over $300 million. In transactions. So it's the kind of thing that comes back to mindset, and that's what I was saying earlier. It's real estate is all about mindset. You got to stick with it. Maybe you start with a 25 unit, maybe you start with a 10 unit, but you can scale from there, because if you buy it right, you're able to go in and either sell it for a profit, or you can refinance it, pull those funds out, and roll them into your next deal. And that's what we've done successfully time and time again.
I was wondering, because the real estate throughout the country, it's there are certain extremes. Obviously, you have in places like Southern California, you have just massive price escalation. On the other end of the spectrum, you have places like Detroit, which is a very distressed environment. I was wondering, do you have, without giving anything proprietary away, is there a process that you have where you select the most viable multifamily units?
Well, this is one of the things that I learned when I first started out. You don't know what you don't know. That's why I created Jake and Gino. And real estate really is it's really local. It's not macro, it's really micro, dealing into the specific markets. So there's 4 market cycles, right? And everyone really needs to know these market cycles when they get into the business, because this is how you're going to have different strategies in the different market cycles. And I can run through them really quick. The first one is recession. So everyone thinks that in 2008, 2009, 2010, the whole country was in a recession. Not true. Knoxville was the 4th city out of recession. So they were the 4th quickest city out of recession. So they might have got out of recession in 2010. Cities like Detroit that you mentioned, cities like Cleveland, they might have stayed in that cycle for longer. So you have the recession, then it goes into recovery, which is the second phase. The third phase is expansion, which the majority of the cities in this country right now are in that expansion phase. And the fourth one is the hypersupply, which means that they're building like crazy. So go take a look at a lot of these cities. Atlanta, Jacksonville. There's a lot of building going on. If they're not being absorbed by the market, they might go into hypersupply, which leads next to recession. So those 4 market cycles over the last 100 years, they've been around a 10-year cycle. So we're on year number 10, basically, from 2008 to 2018. We're getting close. But I think this last cycle has been a little off because as you saw the first 5 or 6 years of the Obama administration, it was a 1%, economic growth. So that really skewed things. And the 2008 recession just changed buying habits forever. You've got people that are not buying homes right now. Home ownership is at a 60-year low. That's why we're here talking about multifamily, because you're talking about there's not enough affordable housing coming online.
Right.
Millennials are renting. Baby boomers are renting. So you've got a much bigger swath. And if we want to go into more macro, you've got a lot of money coming in from overseas. Where is it going? I mean, it's not really going to stocks as much. It's going into multifamily because it's a great lever as far as parking your money. You can preserve your wealth. You can grow your wealth. You've got the tax benefits going on. So there's a lot of different things going on. But I guess that to finally answer your question is you really learn what cities are growing, where the job growth is, where the cities are emerging. You try to get in there before the big money gets in there. And if not, you make sure that city can weather the storm. So once you're in that market, you pick the city, and from there you start analyzing deals and you start building a team in there. And when you start in your beginning, you don't want to go into too many markets. You really want to focus on 1 or 2 cities. So for us, we were fortunate. Jake moved down to Knoxville, and we were stuck with Knoxville. It was in our backyard, and we were lucky that it's an emerging city.
Yeah, I want to elaborate a little bit on that too, because you mentioned, I think, Northern California, and so we're not investing there, or wherever part of California you mentioned, because it's very much buying for appreciation.
Yes,
we buy for cash flow today, and we force appreciation through excellent management. That's essentially what we're doing. We're not buying in war zones. Not that I'm saying Detroit's a war zone, but we're not buying there right now. We like the SEC. I mean, in the Southeastern Conference, you look at some college football. We're buying in those areas. We're buying in the Southeast, and if we see a Chick-fil-A around, we see a Kroger. We like to see some of these different retail chains. We like to see some manufacturing at times. We're next to a large manufacturer that supplies a lot of the tenants or residents to our apartments. So we're really looking for places where population is growing. There's jobs, because we're in the C&B apartment space. We like it, multifamily, I think mostly because it's a basic human need. People need a place to live. Right now, they're not buying apartments on Amazon. They may at some point. Hopefully, we can partner with them. We're not trying to stand in the way. We're trying to accommodate and work with them. So if that's the case, then we're open to that as well. But that's it's not something crazy. At the end of the day, it comes down to income versus expenses, and we try to get really good long-term fixed rate financing on our deals. So we're buying them right, we're managing them right, and we're financing them right, and that has been the playbook.
I just wanted to just ask a quick follow-up question. Mr. Barbaro, you mentioned about the millennial home ownership being a lower rate than prior generations. And of course, that's you turn on CNBC or any other business media like Bloomberg, they always mention that. I was wondering, do you see that trend continuing where the home ownership costs are continue to be unattainable largely for millennial buyers?
Well, it's funny. I just pulled something off. I'm going to read two or three of these quotes.
Sure. Housing
starts in 2019 were 1.3 million. The 50-year average is 1.6 million. So we're 300,000 less on average than what's been the last 50 years. So that tells me that housing, there's a shortage in that housing, number one. Number two, the number of millennials in 2019 is 73 million. The number of baby boomers in 2019 is 72 million. There are 10,000 baby boomers every day reaching the age of 65. Just wrap your mind around that.
It's like half the country between those two groups.
And what are they doing? What they're doing is they're selling their homes in New York and coming down to the Southeast. Or they're selling their homes in California and moving to Boise, Idaho, or Lake Tahoe, Nevada, or Salt Lake City because they're getting the bang for the buck. And they're renting. And the other thing is rents are still cheaper than getting a mortgage. So people really think with their minds and they think with their pocketbooks. Why should I buy a house for $300,000, have to spend $10,000 a year to fix it up, and not get any appreciation because I'm at the high end of the market? Why would I buy a home when most millennials don't know how to fix anything? They know that's a fact. They've got to get somebody out there, right?
Yeah.
They're also saddled with this student debt. Unfortunately, they're starting families a lot later. So who buys homes? Families buy homes. They're having smaller families. They're also transient workers. There's a lot of 1099 workers out there. So it's a great thing and a bad thing because a millennial can actually live in Knoxville for a year and decide, hey, you know what? I want to go down to Florida for a year because I want to work for this company. They just pick up, they leave, and they rent. So the options are there. And there's something called the servant. I was reading a book called Big Shifts in Time. Anybody out there, read the book. It's an awesome book. It's all about demography. They break it down by the decades. So the new phenomenon that the authors call servant, it's really suburban living. It's really like cities like Nashville, like Charlotte, where you're really within the city in 15 minutes, but you have all the amenities.
Walkability.
So you got this, yeah, you've got the mixed use where you've got the apartments upstairs, you've got Whole Foods downstairs, and you've got all these amenities next to you. And it's like you're living in the city, but it's suburban. It's a great place where you can raise your family. And that's where people are more attracting to. The suburbs where you're 30, 45 minutes out, people don't want to drive anymore. People want to have the convenience. So these suburban areas, I mean, look that up. And once you can look that up, you'll see how businesses are being affected. You know, the 80s, I'll give you an example. The 1980s decade was they're called the sharers. So all of a sudden you see places like crowdfunding sites popping up. You see Uber. All these companies are actually going on and trying to service these 80s tenants. And I think apartments are right up there with them. Why buy a house when you can just say, you know what, after a year I'm done, I can change out. So that's where I see millennials and baby boomers at. And like Jake said,
experience. Yeah, the big thing is the experience. They want to have good experiences in travel and sort of things. So the house is a burden and it locks them down. And it's also like not affordable right now. The new houses that are coming online are not affordable homes. They're usually just out of reach. So and then it's pushing up even the older ones. So it's definitely a pricing issue in addition to a lifestyle change.
I see. I think one of the most impressive attributes of your business is that you have so many people of all backgrounds providing real testimonials about their successes using your mentorship and educational tools. You also have real estate experts who are full of praise about your book, Wheelbarrow Profits. In your opinion, what makes your service stand out compared to other similar platforms?
I think very simply for me, I love what I'm doing. I know what I'm doing. I think our unique selling proposition is we do everything in the business. We buy the properties, we manage the properties, we sell the properties, we're getting financing on the properties. So I guess we can consider ourselves a vertically integrated organization where we're handling every aspect of the business, and we're still buying properties, and we're able to teach because, as things go on, no one is really an expert. The markets are constantly changing, rates are changing, buying patterns are changing, technology is changing. So we're in it. We're in the trenches, as Jay likes to say. So that's what gives us the ability. I think the other ability is I became a certified professional life coach. I love the aspect. I love helping people. I love creating that environment where you can get people of like-minded ability. And we're not the shiny object syndrome. We can help you with personal development, but we want to focus on multifamily. Let's learn one thing really well. Let's crush it. And then if you want to go on and start doing some fix and flips, that's fine. But if you're in with us, next 18 months, it's all multifamily.
Yeah, totally. It's authenticity because, to Gino's point, we're not out there, taking pictures in front of Lambos saying, hey, come do this. It's easy. I'm going to tell you right now, it's a lot of hard work. Yeah. And the thing I'm most proud of is that everything that we teach on, we've done it. We have a mortgage company. We have a property management company. We have an education company. We have, probably 30 some holding companies that hold all the different assets. So we have a syndication company. Every asset or every phase or facet of the business we're involved in hands-on. And so we're not sitting here trying to teach somebody on something. And I know for a fact we're the only education group that controls that much of the process. There's no one else out there that does as much as we do, and I'm very proud of that.
Yeah, I appreciate that comment that you made about the Lambo, because it seems like with a lot of these life coaching platforms, it's all about the the superficial element. But a perfect segue. Inevitably, you're going to have, prospective clients who are excited about your services, excited about the educational tools that you provide, but they might have some lingering doubts, perhaps from past failures involving real estate ventures. What would you say to those doubters to consider investing with your organization?
I think the first thing to do is just go on our website, jakeandgino.com. Go on our podcast. We do 4 weekly podcasts. We have a podcast me and my wife do. It's called the Multifamily Zone Podcast. It's all about family. My wife and I talk about actually doing this business with a spouse or with a significant other and how to incorporate that with your family, because that's important. Your whole family needs to be on board. You have to be crystal clear. You have to have clarity of why you're doing this. So I think that podcast addresses it. Jake does a podcast with our partner Dylan called Rand Partners. It's all about syndication. It's a great podcast if you want to learn syndication at a higher level. I do a podcast called Movers and Shakers with our community director Josh, and that's all about our students doing deals. We focus on a student every week on his success stories, what compelled him and what actually motivated and inspired him to get that first deal done. And then Jake and I do our Wheelbarrow Profits podcast, which we bring on, guests such as D. Harv Eker, Robert Kiyosaki, Cameron Herold, all are really high-level individuals. And we just talk about business and business development and personal development, because I think multifamily is really a lot about business building and it's a lot about system building. So that's the first thing I would do. Just go on there, start listening to it, see if it's something you like. And then if it's something you like, we have an apply to work with us page, a mentorship page where you go on board. You'll be contacted with somebody in our department, and start setting goals and see if it's a great place for you to start working with us, if we can help you out. If you're the type of person who wants to stuck with single family homes, it probably won't be a good fit with us. Or like you said, if you've got so many limiting beliefs that no matter what we teach you, we can teach you everything, but it's 80% psychological and 20% mechanical. If you can't get over that psychological aspect, we can teach you everything. You can bring you to water, but which can't make you drink. So
Sure.
That's what we have to diagnose and figure out, I guess, in the front end to see if our services are of value to you.
Yeah, but to Gino's point, not everyone's a fit, and we're not going to take just anybody into the program. So there is a qualification period. So,
Sure.
But in addition to that, what we've set up is the framework: buy right, manage right, and finance right. And so essentially along the way, we're guiding and setting up parameters where we know we're going to have the most success. So on the buy side, we have parameters there. What kind of cap rate are you looking for? What kind of deals are you looking for? For the management side, we have parameters there. And also the financing side, we're looking for long-term fixed rate debt, because we want to really reduce that interest rate risk. So we also look for non-recourse loans. So if you don't know about that, look up non-recourse. It's the best type of financing you can get for these multifamily properties. This is what we're doing because we've learned it through all of our experiences. And Gino can be the first one to tell you, in the beginning, he had some struggles in mobile home parks. So everything that we've done, we're trying to prevent the failures that we made in the past for the folks that we're bringing on board for the education company.
Finally, we're living in, to put into polite terms, an incredibly dynamic environment. Given this context, where do you see the real estate market heading in the next year or two?
See, Jake and I really wouldn't know what kind of environment we're living in because we don't really watch the news.
We live in our environment.
Yeah. So, and I think I like to listen to Billie Jean, and Billie Jean says it best. Entrepreneurs make their own economy. That's what it comes down to. I mean, you can make excuses. It's not the time to buy. And I always tell people mine is it's not the right time to have a baby. It's never the right time to have a baby. It's never the right time to buy an apartment. It's never the right time to start a business until you're ready. And how are you ready? You go out there, you educate yourself, you surround yourself with mentors, you join a mastermind group, and then you'll have the education and the experience, and you'll have the roadmap, the path to do it. And if you don't surround yourself with those people, you will not do it. But as far as apartments, I really don't see maybe a little downtick, but like I said, all the demographics are pointing to up on apartments. Even if the economy slows down, people can't buy houses. What do they need to do? They're gonna rent apartments. That's the trick that I see. If the economy does slow down and they can't buy those houses, they're gonna have to end up renting even more. So the key is to be in a good city, good job market where companies are moving to, and you can actually keep your apartments full.
And here's what I follow right here. You can see it on the phone. It's a 10-year treasury. Right now, we're doing a deal. Right now, the treasury's at 172. We're going to lock probably in the 3.6s on this deal, and we're going to lock for 10 years for non-recourse financing with 5 years of interest only. So that's my world, and there's a 10-year runway right there. So I don't care what all the crazy people in Washington are doing. I care about where's the rates going to be, where's the demand. It's a basic human need. It goes back to it. We want to offer great customer service for the folks that live in our communities. And that's what I'm focused on. And that's what I care about, because I know that 10-year runway, we need to perform over the next 10 years. And then we can, and some of the stuff is fixed for 15 years. Some of it's for 12. So we've staggered it. And that's what we're looking at. And we're trying to focus on our business and not worry about what the crazy people are doing.
I like that. Well, this has been an incredibly informative discussion, and I'd love to continue going on. But unfortunately, we're out of time. But before we go, could you share with us how our audience can learn more about your work?
Yeah, you can check us out at jakeandgino.com. We have an amazing live event coming up this year in October. It's October 19th and 20th at the Gaylord Palms in Orlando. We're going to have 600, 700 real estate investors there with some amazing speakers. We got Eric Thomas, we got the G Daddy coming, Cole Hatter. We got our entire team, so we're gonna have some really great speakers there. It's going to be an entrepreneurial multifamily event where we're teaching on buy right, manage right, and finance right. It's an action-oriented event, and you can learn more about that at jakeandgino.com.
Mr. Barbaro and Mr. Stenziano, thank you for sharing your insights with us at Smart Money Results.
All right, thank you very much.
Thank you.
Thank you.